Time for another portfolio review, and we have got a shocker of a review this week. This is a portfolio I've been sent in where the individual concerned has so many funds. Now they've got a bunch of Wrathbone, Rowe Price, M&G, L&G, Fidelity, Bailey Gifford, BlackRock, Aberdeen, global smaller companies. Now they've bought them at different times, presumably one in a SIP, one in an ISA, and that's fine of itself, so I don't want to double count. The problem is they have, on a £222,000 portfolio, only made £1,800 return. They haven't specified over what time frame. Let's assume it's since the 1st of May. Now that's a year in which, since then, the S&P had gone up 25%, the NASDAQ had gone up, I don't know, about the same since that period, roughly. So they've only made, well, under 1%, well, sorry, under 2%. And that's worrying. Now, that's not necessarily what they were tracking. Maybe they just want to have a lot of funds because they want less volatility. That's fine. It's just that each of these funds will have about 100 stocks. So what they've done is, they've got about 1,000 underlying stocks. They've just over-diversified, if anything. What might be a better approach? Well, I'm going to show you what I suggest is a better approach, which is that what they do is they decide, first of all, how much do they want in funds, so the asset allocation aspect, and I'll just show you that very quickly, first and foremost. This is from Goldman Sachs Asset Management. It's not particularly controversial. Some say it's a little bit less risk averse. Let's say they're at retirement, for argument's sake. They might say, well, you know what, we'll put half our money in fixed income or cash, high-yielding cash in a savings account or a bank or a bond ETF, bond exchange traded fund, and the rest will go half and half, let's say 25% in equities, 25% in funds, or they might just put 80% in funds. My point being that once they've decided that and they've come upon the funds, the real factors they should be looking at, and I think it should be about 5 funds, maybe a S&P tracker, a FTSE tracker, maybe a FTSE World Index tracker, perhaps, if they really want low volatility. These are the factors they should really be looking at. A high Sortino, a high average return to downside risk, alpha, outperforming of the market, volatility relatively low, presumably that's why they're in funds and not individual stocks. And that one, if you take the Euro stocks banks, that's generated you 10% over the last 6 months in any event. There's a whole bunch like that. You don't have to go over that. Don't have to go over any of these, of course. But I don't know, look, here's another example of one that I've found. The Invesco S&P Small Cap Value with Momentum ETF Small Value, that's 18%. These aren't individual recommendations, by the way, because I don't know your personal circumstances. I'm just giving you ideas what you should be looking for. And then you might add some stocks to that if you wished, and if the risk profile suited you, maybe 10 stocks, maybe including some of the blue chips like a Microsoft or whatever else. But what worries me here is there just isn't a strategy. There is a spray and pray. There's over-diversification. I suspect their wealth manager or IFA has got their grubby little hands on this, and that's why they've been flogging these, because the IFA is going to get commission each time somebody buys some of these. And so spray and pray, there's a bit more commission, there's a bit more commission, goes to their kids' school fees. And that worries me. That worries me with this one in particular a hell of a lot. So I'm going to have a chat with this particular individual and let her know where I think she's going wrong and how she might start the first steps to correcting it. Okay? Like and follow for more portfolio reviews. Thank you.